Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 58 on April 19th, 2019. I'm your host, Eric. And in this week's show, we will cover the trades from last week on PG&E Corporation, eBay, and GE, General Electric. And we discuss three new trades on Freeport-McMoRan, Morgan Stanley, and the China Large Cap ETF. Now, it's always great to hear from listeners. If you have any questions about the trades presented here or about your own positions, feel free to email me. You can reach me at Eric, E-R-I-C, at theweeklyoption.com. That's ERIC at theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to understand in order to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or simply find us on YouTube. Our YouTube channel is The Weekly Option. Now, just to dive into the markets, this week, the markets ended the week on Thursday. So today, Friday, the market was closed. Today is Good Friday, so market was closed today so that people could celebrate the 3-day holiday weekend for Easter. There was very little change week over week. So the Dow Jones Industrial Average grew 142 points, ending the week at 26,559 points. The S&P 500 index lost 2 points, so not much at all, ending the week at 2,905 points. And I'll go ahead and dive into the topic of the week. And this week, the topic is really a function of a conversation I had a couple days ago. So I went to dinner on Wednesday night with about, we'll call it 10 or 11 other energy traders that I know in Houston. And, at the end of the night, we're talking about option trading. I told them, that I have this podcast because I haven't shared it with a whole lot of folks, but I like the fact that you guys who are listening, most of you found me, which is how I know that you're interested in option trading, which is great because I really don't need my mother or my aunts and uncles listening to the show because they don't trade. So anyway, I'm talking to them, and one guy was making the case that he just likes to, sell options. He likes to be, in fact, several of them were saying, or one guy in particular was saying he likes to sell options, and the other guys in the room were saying how they don't like being short options. Now, they'll use phrases like being short gamma, short volatility. At the end of the day, what they mean is to have a net position that is short the options market. And as this sort of argument going back and forth continued, I very quickly realized that the guys who were talking about not wanting to sell options were energy traders. They were commodity guys who look at option trading. And the guy who said he liked to be short options was a bond and currency trader. And since I started off my option trading career in the equity markets, I understood the difference. In equities, you really, most equity option traders I know are happy being short the market, happy being short volatility specifically, which means they have a net short position on in the options. Whereas in commodities, commodities have a couple of, I guess the easiest way to put it is there's this thing called tail risk. And that is, so if you think of a bell curve, you have a normal distribution, and out on the edges are where the crazy things happen, right? It's where, when you're two standard deviations, you're beyond two standard deviations from the mean, either up or down, and that's where craziness happens. That's where people make millions, but more often than not, people lose their jobs, they blow up their positions. So, a lot of commodity traders, specifically in the energy market, don't like to be net short volatility because of those the frequency of those tail events. When they happen, it really blows your position up. So that just got me to thinking, and it made me want to point something out, and that is there's value in focusing on a niche and really getting to know a specific area, because option trading can be very nuanced, and not all markets are the same. Now, if you understand even the basic principles that I talk about on this show, you understand how to put together a spread and know that if you buy it, the most you can ever lose is what you paid for it, and if you sell it, the most you can ever make is what you receive when you sell that spread. And you know that right off the bat, your risk is capped, and your gains as well are capped. You can do that in any market. It doesn't matter if you're trading bonds or move over to currencies or energy or whatever. Now, that being said, there's still value in really learning, like niching down and understanding either an industry or a company or group of companies. So even though I look for trades all over the place for this show, just because I don't want to bore my listeners. I don't want to bore you guys with, hey, we're going to look at trades in the S&P 500 again. We're going to look at trades on the diamonds, the ETF for the Dow again. Even though I don't do that with each show, I don't do that because I want to keep this show interesting and new. But if you were to look at my trading positions, a lot of times I stick with ETFs that I know. And what ends up happening is you gain an understanding of how the stock itself trades, and even better, how the options trade. So there are times that I'll look at a stream or a string of option prices, and I start just pricing call spreads, closer to the money, out of the money, put spreads and whatnot. I already know just from the way prices look, whether the market is expected to head higher or lower. I don't even have to look at the stock chart. I'll look at the stock chart just to validate or to confirm, but the option prices end up showing that to me. And that's a function of just my experience and me spending time focused in specific areas. A lot of times, I've said it before that when I sell a credit spread, when I sell a spread, I like to receive at least 30 cents on a dollar, or 15 cents in a 50 cents range. There's a reason why I came to that. If I look at a call spread, or if I look at a spread and it looks like I can sell it for 60 cents and it's on a dollar, I know that something's up, right? It's because I'm familiar with option pricing and the way that that risk is priced relative to the time that's left in it. So if it's 60 cents, chances are the market has probably gapped up and is expected to go higher in a direction. So those sorts of things, you start to just, if you stick with a handful of companies or an industry or whatever, it really will teach you options, because you'll get used to seeing certain things. You'll be able to point out like, oh, that's normal, or wow, that's really inexpensive. I wonder what's going on. So let me look for the news. Or, ooh, that's really high. I bet something's going on in this stock that I should look at, so that I don't kind of get suckered into selling this. I don't get suckered into a trade that I shouldn't. And the other thing that's great too is sometimes you can get to the point where you start doing pairs trades. And it's funny, I hadn't put it in my notes to talk about that, but pairs trading is when you trade companies or indexes for that matter, but you trade things that have a similar makeup or maybe similar industry, or even complementary or competitors, complementary or substitute goods, but you trade them against each other. It's like looking at Procter & Gamble versus Colgate Palmolive, sorry, or looking at, say, Coca-Cola versus PepsiCo, or looking at Boeing versus Lockheed Martin, Delta versus American Airlines, looking at Morgan Stanley, which we're going to look at a trade today, and comparing that to a JP Morgan or Goldman Sachs. So when you really start to get good, you'll be able to realize like, okay, well, something's going on that's different here. I can actually trade this option over here and use this other competitor that seems to be priced normally as my constant. So I would either buy the one that seems too cheap or sell the one that seems too high and own the one that seems normal, or do the opposite. You offset the trade with the normal one. So it's that's the beauty of just sticking with one industry. So I challenge you guys to take a moment and look at where you've made money in the past. Let's start there. If you've been trading options for a while and you're like, I like trading all these different companies, but I almost always make money when I trade this area, man, go back in that area and just hone in on it, right? And become an expert. You just because you work as a lawyer or doctor or librarian during the day doesn't mean that you can't become an expert in an area of options. So and trust me, as you guys get better at or get good at trading spreads and doing all of this, you're actually becoming an expert. You'll be amazed at how well you could keep up in a conversation like what I had a few nights ago, because I have experience. I know what I know, and I'm confident in my knowledge of option trading, and that's why I'm able to have this show. And you guys who listen to me regularly, some of you have been with me since week 1 or 2. So as you're listening to the show, you're going to get good. And when you get good, hit me up. Like I just want to give you like a virtual high five for sticking it out, because so many people lose money in options, and that's simply because they don't understand options. And I'll take some onus. They don't understand options because the industry teaches options in a really convoluted manner. But if you can take away some of the complexity and just get down to where do I make money and where do I lose money, which is the whole concept behind this show, you can get good at trading options. And you can always go back and add complexity. I mean, if you ever want to talk about delta and gamma, if you want to talk about how to manage your short gamma, let's talk. If you want to talk about how to make money being long gamma, let's talk. If you don't know what gamma is, that's okay. You don't have to know what gamma is to make money trading options, and that's the beauty of it. So that's it for this week. Take some time, really focus, get to know an industry or a company, and with that knowledge, you'll become a better trader of that industry or company, but it'll also teach you a lot about just option trading in general that you'll be able to use when you're trading other products. So this week was actually today, Friday. This week was options expiration for April, and I don't know that I've ever seen an options expiration on Easter. It's kind of interesting. Either that or I've got a short memory, both of which are possible at this hour. But today is Good Friday for those of you who celebrate Easter, and for those of you who don't, that's why the market was closed today here in the U.S. So let's take a look at the trades we had on last week. So we'll start off as usual with our covered call. We looked at PG&E Corporation. This is the Pacific Gas and Electric Company. They are a huge utility providing power for the state of California. The stock symbol is PCG, Paul Charlie George. The stock last week ended the week at $23.08. And I was looking at the May 24 call, selling that at $1.69 against owning stock, since this is a covered call, and hoping for an 11.31% return in 5 weeks. Well, PG&E stock fell $2.08 this week, ending the week at $21 per share. Now, that's a direct loss on the trade. That stock fell, and there's nothing you can do about it. The call option, which we sold, can actually be bought back, can be repurchased for 90 cents right now. So that allows you to lock in a 79-cent gain on the option. So between what you gain on the option and the stock loss, that means that right now we are $1.29. We're $1.29 per share in the hole on this trade if we were to close it out today. Now, since it's a May trade, there's 4 weeks left before expiration, so we can do a number of things like rolling the strike lower. So if we sell the May 21 call, right, and with stock trading for $21, this is the at the money call. So if we sell the May 21 call, we'll collect $1.67. So if you add that $1.67 to the 79 cents that we locked in on the original trade, that means that we've collected a total of $2.46 in option premiums, and that more than offsets the $2.08 loss that we took in the stock. Now, it also means that as long as stock finishes at $21 per share or higher in 4 weeks, we lock in a 38 cents per share gain on this trade. Now, I know it's not much, but it certainly offsets the loss. If you only own PG&E stock without using any options, you just sustained a roughly 10% loss on your position in 1 week. Using the option strategy would actually allow you to mitigate the loss in your stock and possibly even squeeze out a little bit of a profit. So, add that to the reasons, to one of the many reasons why you should not trade stock without having an understanding of the options market. Options can save your butt. I had to figure out the right way to say it. But they've saved mine over time, and that's for sure. Now, the next trade we had is a credit spread on eBay, symbol, of course, EBAY. That's Edward, Barry, Adam, Yellow. Stock finished last week at $36.17. We looked at selling the May 37.38 call spread and collecting 34 cents, which creates a maximum possible loss of 66 cents per share or per spread. Now, eBay stock fell 19 cents this week, closing at $35.98 on Thursday. Now, that's not a huge move down. It's only 19 cents, but it's heading in the right direction for our trade to make some money. So if you tried to exit the trade right now, you would actually buy it in for 35 cents. That'd be crossing the bid-ask spread. So if you were to, that means paying the offer and selling the bid. However, if you were to try to add to this trade right now, if you were to try to sell more of the spread, you would receive 29 cents this time, because we received 34 cents last time. So, we received 34 cents last time. So, this is net. Actually, we received 36 cents last time. But at the end of the day, there's a bid-ask spread that either means that you lost a penny or you made 7 cents. So really, it's somewhere in there. But if you were to lock in that 7 cents, right? If you were to try and sell it, or if you were to try and buy it back, buy that spread that you sold back, and just lock in the 7 cents. 7 cents on a 36-cent spread, that's still 20% on your money in 4 days, right? Like, think about that, 20% on your money in 4 days. So you'll have to decide whether you want to stay in this trade or not. I'll watch this spread over the next week and decide whether to stay in it or exit. But stock is $1.38 away from our break-even point. So at this point, it's not worth closing early. I like these sorts of trades. You have to keep your eye on them, because you don't want stock to swing back the other way. If it does, you need to find a place and look at exiting. Or, of course, we know that if we've sold a call spread and the market is rallying, we could also sell a put spread as well and turn it into an iron condor. So there's all sorts of stuff that you can do. At this point, the trade's working out, so I'm just going to hold on and let it play out. Our final trade to review from last week is the debit spread on General Electric, symbol GE, George Edwards. At the time, the stock was trading for $9 even, and we looked at buying the May 10-9 put spread. We're paying 65 cents, which creates a maximum gain scenario of 35 cents, or roughly 54% return on the spread. Well, GE stock ended the week at $9.35 per share, which was a gain of 35 cents. Now, this also happens to be our break-even point for the trade. So the put spread, which we paid 65 cents for, is now worth 52 cents if we were to close the trade on Monday. Now, that would actually lock in a loss of 13 cents, and I'm not convinced that this stock is truly going to rally. So I'm looking at holding on to this trade, but definitely keeping an eye on stock. Again, there's 4 weeks left in this trade, and we can always sell a lower put spread or even a higher call spread against our original position to protect it a bit. So on Monday, the half strikes will be priced in, and I would look at, if you took this trade, I would look at the pricing for possibly selling the May 9, 8.5 put spread, or even the May 10, 10.5 call spread against this trade. And I can't, without those strikes being priced in right now, I can't really give a full opinion on it, on which is the better sell. But the beauty of it is, come open, market open on Monday, we'll have more data and be able to make a better decision. So definitely keep an eye on that if that was one of the trades that you put on. Now, this week's trades, this week we've got, we're post expiration. So of course the half strikes are not priced in yet. And the more expensive stocks, the stocks that are trading for over, say, 80 or $100 a share, the $1 strikes are not priced yet either. So as of the market open on Monday, you might find some trades that actually are better than the ones I'm going to mention here, based on their pricing and on their value. So this is an educational show, but these trades right here are certainly educational, because on Monday, the half strikes might actually make it worth putting on one of those rather than some of these. So we'll start off with the covered call on Freeport-McMoRan, symbol FCX, Frank Charles X-ray. The stock ended the week at $14 per share. I'm looking at owning that stock and selling a May 15 call at 33 cents, shooting for a 9.5% return in 4 weeks. Now, you enter this trade by buying Freeport-McMoRan stock at $14 per share and then selling the May 15 call at 33 cents. This trade makes the most money if stock prices finish above $15 per share. Now, our second trade on the week is going to be a credit spread. We are looking at Morgan Stanley, symbol MS, Michael Sam. The stock ended the week at $47.55. I'm looking at selling the May 47.46 put spread, collecting 34 cents, and that creates a maximum loss scenario of 66 cents. Now, you enter this trade by selling the May 47 put at 98 cents and buying the May 46 put at 64 cents. This is the credit spread because we are selling the spread, and this trade makes the most money if stock prices stay above $47 per share. Then our final trade on the week is going to be a debit spread, and this is an ETF I actually haven't traded before. It's the iShares China Large Cap ETF, symbol FXI, Frank X-Ray Isaac. Stock ended the week at $45.73 per share, and I'm looking at buying the May 45 half call spread, paying 35 cents for this call spread, which creates a maximum gain scenario of 15 cents or a possible 42.86 or 43% return in 4 weeks. You enter this trade by buying the May 45 call for $1.36 and then selling the May 45 half call at $1.01. This is a debit spread because we're buying the spread, and this trade makes the most money if stock prices stay above $45.50 per share. Now that's it for the week. Happy Easter to everyone. Hope you have a fantastic weekend and a lovely week. Happy trading, and definitely hit me up via email if you have any questions. Take care.
Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.